We are ready to begin our meeting.
We got people in?
We have people.
Recording in progress.
Thank you. We'll start with the roll. Vice Chair Jennings?
Here.
Trustee Abbott?
Here.
Trustee Avasti?
Here.
Trustee Chandra?
Here.
Trustee Faulkner?
Here.
Trustee Linder?
Here.
And the chair is here.
Chair, do you mind if I qualify Trustee Jennings?
Not at all.
Thank you. Trustee Jennings, I understand that you are appearing remotely under AB 2449's emergency circumstance. Emergency circumstance is statutorily defined as a medical issue preventing the person from participating in person. Can you please describe for the board your medical condition?
Yes, I got COVID, so I'm at the very end of that, and thought it best to stay home.
I hope you feel better. I just have a couple more questions for you, just two more. One is anyone with you over the age of 18 in that room where you're teleconferencing from?
No.
And do you agree to keep both your audio and video on for the duration of the meeting?
Yes.
Okay, thank you. And so Trustee Jennings has satisfied the qualifications for AB 2449. However, under 2449, it requires a board action to accept her medical condition. So we need a motion to allow her to participate under that exception.
So moved. We have a motion from Trustee Chandra. Do we have a second?
Second.
Second from Trustee Linder. Any public discussion? Any public comments? All those in favor? I guess I have to do a roll call vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
She can't vote.
Oh, okay. Okay, so can we raise hands then of the remaining?
Yes.
All those in favor? No one opposed to Julie participating? Okay, she participates.
And then for all other votes will be roll call votes.
Yes, of course. So a few ground rules, since this is a hybrid meeting, all votes, as Council Chin just mentioned, will be roll call votes. Orders of the day, I would like to take item 6C under new business. I would like to hear that before closed session. And if there are any other suggested changes to the orders of the day, I think we'll need a motion and a vote on that. Is there a motion?
So moved, Mr. Chair.
Motion from Trustee Linder, a second.
Second.
Second from Trustee Faulkner. Any discussion, any public comment? Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
Chair votes aye. The orders of the day are approved. We do not need to waive sunshine. And at this time, I will take public comment on any item that is under the purview of this board that is not otherwise agendized. Speakers will be limited to 3 minutes. Is there anyone here wishing to speak or anyone online? There is no comments from anyone online. So we will proceed with the agenda. So the first item is in fact 6C, which is...
Labor negotiator for chief investment officer.
Right, the appointment of the labor negotiator. I think this is normally, in the case of the CIO, is normally the chair of the investment committee, but I guess it need not necessarily be that person. So if you want to take any nominations for labor negotiator, this is to coordinate with police and fire the exact raise and rating for our CIO and coordinate with police and fire on that. Is there anyone who would like to volunteer for that position? We have a volunteer from Trustee Chandra.
I was just getting ready to nominate him. So.
Do we need a first and a second on that?
Yes.
Okay, and Mr. Linder, would you like to second that motion?
Second.
Okay, any further discussion, any public comment?
I'm sorry, I missed the first. Was the first?
Was Chandra himself.
Okay.
The man himself. For Trustee Chandra to be labor negotiator. So
Wait, did I just nominate myself?
I believe you did.
Okay, all right.
That's-
I volunteered
Is
to
that-
do it. I thought
You thought you were stretching,
I
right?
thought there'd be a different first and second, but that's fine. It's a little narcissistic.
Oh,
of
okay,
me,
well,
I think.
then I will second to give
Okay,
you some
just-
sense of
so-
encouragement.
So just for the record then, so the first is Linder, second is Chair Horowitz.
Sure. Let it come from the chair himself. Any further discussion, any public comment? Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Vasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And the chair votes aye. You are the approved labor negotiator, Mr. Chandra. Okay, we will now proceed to closed session for a number of items. Let us reload the octave. Let us convene to the back gate. was reminded that we had not yet approved the consent calendar, and prior to doing that, I'd like to pull item 2.1A.
I apologize, Chair. Do you mind if I report out the?
Yes,
session?
please go ahead.
So, for items, closed session items 1A, C, and D, there was no reportable action. However, for item 1B, there is a reportable action. So the board approved up to 2.5% in 5 executive days for the performance evaluation of the CIO.
Great, thank you. And then moving on to consent calendar, I would like to pull item 2.1A from the consent calendar. And if there are no other adjustments to the consent calendar, I'll entertain a motion to accept the consent calendar.
I'll make a motion to accept the consent calendar.
We have a motion from trustee Chandra. Do we have a second?
Second.
Second from trustee Linder. If there's no further discussion, Vice Chair Jennings, how do you vote?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
Chair votes aye. Consent calendar is approved. We will now move to item 3, death and survivorship. We will have a moment of silence for those who have served the city and who have passed. Thank you. Agenda item 4A, oral update from our CIO.
Good morning, Mr. Chairman. Good morning, trustees. Makita will actually discuss the last fiscal year returns this morning. But I would also like to share some numbers with you. I don't like to talk about our own performance, but I think sometimes our stakeholders should know what we do, the magic that we've created at ORS. I don't think we get enough credit for that. So I am going to share some numbers, and this is not to convey how great the investment team is, but how great this system is.
Okay.
Meaning boards, staff, consultants, and everybody else who contributes to this. So with that background, so I joined the system in March 12th, I believe, of 2018. And the first full quarter was June 30th, 2018. And at that time, our assets were $2,071 million. This is the Federated pension system, not the healthcare. And our 1, 3, 5, and 10-year numbers were all in the bottom 1% of our peers. I'm going to repeat that. 1, 3, 5, 10-year numbers were in the bottom 1% of our peers.
Wow.
Not in California, but nationally. Okay. So Laura will later share numbers which show that our 5-year number is now in the top 10% of the nation. So we are in the 9th percentile in the country. Okay? And along the way, in the last 6 years, and I asked Harrison to calculate this yesterday, we've actually had investment gains of $1.2 billion. $1,211 million. And our net cash flow, this is gross investment gains. Of course, our sponsor pays us money to pay benefits, and we are a slightly cash negative plan. So the contributions from the sponsor minus the distributions that we pay to our beneficiaries was $135 million, a negative $135 million. So we started at $2,071 million, and we ended June 30th at $3,151 million. And that was an 8.5% annualized return over the last 5 years, which again put us in the top decile of our peers. Along the way, we beat our assumed rate of return by 175 basis points, roughly, because our assumed rate of return was not always 6 5/8, but it's an approximate number. And you will see that our portfolio beat its investable policy benchmark, its investable policy benchmark, its low-cost passive benchmark, its 60/40 benchmark, and its liability benchmark portfolio in 5 years. And there's more. I know 1-year numbers are not that important, but in the last 1 year, we beat the highly resourced and talented CalPERS, the highly resourced and talented CalSTRS, the very talented San Francisco Employees Retirement System, the San Mateo County Employees Retirement System, and the Contra Costa Employees Retirement System. So every one of our peers in the Bay Area. And on the healthcare side, we've added 111 million net, so you can add that to the 1.2 billion. I'm not going to give more numbers there. And also in 4 of the last 5 years, we beat the assumed rate of return for both those plans, the healthcare as well as pension. And I'm saying all this because it's important for our stakeholders to recognize this kind of performance is not accidental. It is by design. And I have all the humility to acknowledge that, you know, you also need some luck. And we've had our share of luck. But you all have supported us with resources. You've supported our asset allocation moves. And we've made some pretty big, bold moves, 2 of them, in fact, that were very contrarian. And the board supported us in those moves. And I'm saying this because not only should our stakeholders recognize this, our beneficiaries should recognize this, but the boards that have been so supportive of our investment staff should continue to support this excellent team. I'm not at the beginning of my career or at the middle of my career, but those guys are, and you want to keep them for a long time. And so for that reason, I'm saying that. And in fact, I was at a conference yesterday at Stanford, along with Trustee Chandra, and there were some $7 or $8 trillion of assets represented at that conference, with some of the largest pension plans and sovereign wealth funds around the world, and some extraordinary talent in that room. And as I was watching each of those sessions and some of the speakers come and talk about various asset classes and the markets, I could not help but think that our team would have actually matched wits with some of those very senior people. So with that request that you recognize our staff and do everything to retain them, and I've always told them that the board is very supportive of our team. We want to keep this team intact, and hopefully for a long time. With that, thank you for your indulgence, and I will turn this over to, unless you have questions, I'll turn this over to our consultants.
Well,
First,
First-
I'd like to, I'd
Go
like to
ahead,
comment,
Trustee
but
Chandra.
Please go first.
well, I was just gonna absolutely congratulate you on an incredible run. All the numbers you report are extremely exciting. I think we all, as trustees, feel enormously appreciative of the staff, including their leadership in the person of the CIO. In recounting our relative performance to CalPERS, CalSTRS, all the local competition, you neglected to say if Fed is beating police and fire, which is,
I do have 2 masters, so.
and I'm just also curious where we are fiscal year to date.
Yes, I have those numbers. The pension plan is up 2.6% as of 2 days ago, and the healthcare trust was up 3.2%.
So if I may, a
Mhm.
couple of comments. First, congratulations, and you know, I've been here for your entire tenure and most of this staff's. And all I can say is I'm glad that we've been able to support you and kind of get some of the governance and some of the things that were completely amiss right, so you can do your jobs effectively. And so thank you for your leadership. The second thing that I wanted to mention is this conference that we attended, there was a presentation by one of the most prominent endowment funds in America, who shall remain nameless. And when they flashed their asset allocation up on the screen, I turned green. It was very shocking to see a group with that many resources, that caliber of talent, to, I believe, not have the rigor or the thoughtfulness that we've been able to apply here. And I would imagine that our CIO and staff's returns supersede theirs. So we're not just beating pension plans around the country, but I think we're even taking on some of the folks who are supposed to be the smarter players in the asset allocation world. So anyway, I just wanted to make sure that we broaden the scope. You guys are doing a terrific job across all peers.
Great, thank you, trustees.
Okay.
I just wanted to second what they had to say, and it seems to me like what you and your team are demonstrating are 2 things. Not only knowledge, but also nimbleness, because I think it's some of that nimbleness that allowed us to have this extraordinary performance.
Thank you, and that is really thanks to, as Trustee Chandra pointed out, governance and the support of the boards that allow us to be nimble. In fact, I didn't want to mention about the endowment, but it seemed like endowments generally are considered to be more nimble and have better governance than public plans, but it seemed like they had sort of straitjacketed themselves and sort of confined themselves to a very narrow box.
Yeah, the governance was really disappointing to learn about as well, to be honest with you, not just the performance. Yeah, it was relatively unsophisticated.
Interesting. We may need to follow up on that outside of this meeting. All right, if there are no other comments, we can proceed to 4B.
All right, thank you. And I would like to invite the very talented Casey Boyer.
Hi. Welcome
Yep.
to everybody and good morning. Appreciate, as always, the opportunity to present our private equity strategic partnership with you all. And congratulations to everybody, board, team, for the performance over the last few years. I know it has been extraordinary, so congratulations. I will share my screen. Today we are, and everybody let me know if you can't see it, but we are going to go over Q1. Private equity typically has a little bit of a lag in terms of reporting, so Q1, Q2 will be out very soon, and I can walk through a little bit of what is expected for Q2. But for Q1, your plan specifically was pretty much par, but up slightly.
Thank you.
And so when you're looking here on the summary page, I'll remind you that we started our partnership back in 2017. So the middle 2 columns strategic partnership MB Series 1 and Series 2. Series 1 and 2 are the same investment strategy. We are just kind of categorizing them for really performance purposes. And so following the same strategy, we are now fully committed in Series 1, and we are actively committing out of Series 2. And of course, all of this, the investment pace and how we're actually committing over time is in full discussion and constant interaction with the investment team there at San Jose. So as I said, Q1 was up slightly. We technically went from a 1.84 net TVPI to a 1.86. Overall, for Q2, we are expecting similar performance, probably around par, could be slightly up. When we look over our entire platform for Q2, estimates for the quarter was around buyout being a little over 1% up and venture being around 1% down. So really accounting there from a broader private equity market landscape, that was what we were seeing kind of across the market was Q2 right at par. I would say the only other thing to mention here on this page from just kind of a general private market standpoint, we've continued to see not as many exits as historical in years past. So 2023 and continued into 2024, not as robust of an exit market, meaning distributions and companies selling at an underlying portfolio company level are not happening as quickly as typical in the past. Of course, there's always discussions of when that will tick up. And it obviously relies on a lot of factors, but there is a robust pipeline of companies that we do see that would be viable to be sold or to IPO. And so hopefully those floodgates will open soon. Typically, we're entering a period in Q4 where exits do seem to tick up. It's kind of seasonal where companies are trying to, if they are looking to sell, they would like to sell before the end of the year. So we'll see if that happens to be the case in Q4. But overall, from a performance standpoint, Q1 up very slightly and expect Q2 to be either on par or up slightly. I'm going to skip some of this very detailed information, but I'm happy to answer questions on it if anyone has it. Turning to page 10, we're highlighting gross performance, so the performance of the underlying investments by investment type. And on the bottom, you'll also see the benchmarking of the entire Series 1 portfolio. And this is from a primaries, co-investments, and secondaries standpoint, we're really seeing good positive performance generation across all of them. You'll see primaries at 1.5 times. That will hopefully tick up over time. Primaries take much longer to develop. There's still some primary fund investments that are still putting money or investment into companies. And so that should continue to develop over time. Co-investments and secondaries really adding early benefit to the overall portfolio. And you'll see the benchmarking. Unfortunately, the IRR just slipped down into, over median. We're really close there to the first quartile. You'll see how specifically Q4 to Q1 changed, obviously very close. The page 11 is the same exact page, but now for Series 2. You'll see we've had a really good start to the portfolio. Not a ton of capital has been put to work. So over time, I would expect this overall performance of net TVPI of 1.4 to actually come down as we're putting more investments into the ground. They're coming in at cost. And so that would likely trend down over the next few quarters until we see some early generation of portfolio enhancements and returns. This early secondary, you'll see there is one secondary in the portfolio. That was an instance where we were able to buy a set of companies where a fund was kind of in a wind down mode. So they were willing to sell at a pretty heavy discount. And so we were able to see early gains right away just from buying at a very attractive price. And as a reminder for benchmarking, it takes 2 to 3 years for benchmarking statistics to be available for portfolios as portfolios are developing. So as soon as that is available, we will include them here. And then page 12 is really just the combined portfolios. So Series 1 and Series 2. Obviously, this will look very, very similar to Series 1 at the moment, as that has a far majority of the capital to work. And I'm going to pause there and open it up for questions, or happy to go into detail as needed.
Any questions from trustees on what's been presented? Can you just, sorry, go ahead.
You can go first.
No, go ahead.
Just a very specific tactical question on secondaries, and I know I've talked to the staff in the past, at least in the venture space. I thought this was a really good time period, and I noticed over both series that, and I know Series 2 is really early, but we already have this really nice deal that Casey just mentioned. Any perspective from the staff or Casey on how secondaries will perform going forward?
Yeah, I mean, the secondaries are very opportunistic, and when we are investing secondaries and co-investments, we think of it as a bucket where there's time periods where it makes a lot of sense to put more capital into secondaries, and then there's time periods where it makes a lot of sense to primarily focus on co-investments. I think, from a secondaries standpoint, prices obviously change very quickly. We've seen in 2024 discounts a little bit tighter. So this transaction was done actually quite a while ago. And so we were basing our pricing off of an older NAV, and our team had a really good relationship and were able to close this over time at that same purchase price. And so I would say now the market is probably a little bit tighter from a discount perspective for secondaries. The secondary market has expanded tremendously from just traditional LP secondary transactions to GP-led transactions that could be either single asset deals or multi-asset class deals. This particular secondary was a multi-asset class deal in Europe. And so there's so many varieties, and they all have very specific time periods of when they're interesting, and you just really have to stay super current and look at the market very opportunistically to find the really attractive asset-based secondaries. And that really is what our secondary team focuses on, is being very diligent on the assets that we're buying, not just focused on the discount, although the discount is always nice.
Thank you. Thank you.
And I would add from the staff perspective, discipline is important because there are discounts available, but the underlying assets need to have the value to be able to produce the returns. And in this case, the secondaries, they do have the DPI as well, so 1.18 times. So we've actually been able to get the money back. So it's not just bad assets that are trapped for a long period of time, but actually being able to get that return of capital and returns. And even outside of the buyout program, we've been active on the secondary market. So last year, we bought a real estate secondary, and currently we're also in the process of completing a transaction with a non-US seller of another real estate fund that we have interest in. And in the sister plan, Police and Fire, in 2021, we sold a portfolio of buyout funds. So we're constantly monitoring the market. When it's a good time to be a buyer, we'll be buying. When it's a good time to be a seller, we'll sell.
Yeah, no, I noticed the DPI, which is why I asked. I was just curious where you think we're. It's cyclical, as Casey said, which was the base of my question. Are we going to see less of it going forward? So if spreads are tightening, that's one sign we might see less.
Yeah, and you know the venture market well. I just got a note from Trustee Lee that he's seeing a pickup in activity in secondaries.
Okay. And if you could just maybe briefly touch on the logic in partitioning the Series 2 from Series 1?
Yeah, so typically when you are looking at a set of investments, and if you even think about it from a benchmark standpoint, many portfolios are set up in a typical standard where you're investing over a 2 to 3 year time period and then analyzing your performance on that group of investments. And so kind of separating that and also giving your team the ability to maybe change any dynamic that they want to in Series 2. So there are obviously discussions all the time of kind of what types of investments we're making, how quickly we're making investments. And so it's a delineation that's primarily based on how we're looking at performance and benchmarking ourselves against peers that are doing a similar set of investments.
And if I can add, yeah, so there's two main reasons. So the first is benchmarking. So Series 1 is 2017 vintage. Series 2 is 2023. So being able to compare to appropriate peers is one part. The second part is our investment council actually recommended this legal structure to provide the best protections for the plan for a long-term private equity strategic partnership.
Okay. But Series 1 includes multiple vintages?
It does, yes.
Okay, and Series 2 will as well. Okay, so at some point we simply close the curtain and open the new series?
Correct.
Okay. All right, thank you. Any other questions? All right, we can move forward. It's come to my attention that we skipped over agenda item number 1, which was a rescission of an application for a change of status for a service-connected disability. We had a recommendation from the Disability Committee, and the board needs to acknowledge and accept the withdrawal of the disability applicant. So I don't know if there's any further background on that, or if not, we can simply have a motion and
It's pretty
Accept-
straightforward, so
Mhm.
I'll move the action.
thank you. Motion from trustee Linder, is there a second?
I'll second.
Second from trustee Chandra, any discussion? Hearing none, we will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti? Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
Chair votes aye. So that is approved, and we can now move to agenda item 4C.
All right,
Which
thank you,
is
Mr. Chairman.
quite a
Thank you,
market.
Casey. And for this, let me, the very talented team from Makita.
Good morning. It's nice to see everyone. I can't believe it's getting towards the end of September already. We, as your Chief Investment Officer previewed, have some good news to report on the investment front. I'm going to turn things over to my colleague, Colin Kowalski, who's going to introduce himself. You all probably recall Jared Pratt, who used to work on our team at Makita. He's still at Makita, but he relocated to Albuquerque to take care of some aging family members, and it's a lot harder to get from Albuquerque to San Jose than it is for us in our North San Diego office to get to San Jose. And so Colin's been with us for some time, is an experienced analyst on our team, and I'm pleased that he was willing to join me and join me for more meetings as well. So you'll be seeing him going forward.
Great, thanks, Laura. Hello, everyone. Good morning. It's great to be here. As Laura mentioned, I've only been working with you all for a handful of weeks behind the scenes, but this is my first time in front of this board in person. I'm excited to meet you all and work with you going forward. As Laura mentioned, I've been with Makita for a number of years now, working out of our Carlsbad office, pretty closely with Laura over the years. Prior to that, I worked at a competitor consulting firm, so I've had some time in the industry. Excited to work with you all, and I will go ahead and get started on our first agenda item today, which is the private markets report as of the first quarter of 2024. Here on page 1, you can see a table with a list of all of the private market programs for the system in place here. The top 2 ones are the legacy private equity composite, as well as the NB Fund of 1, which we just went through a moment ago. Further down the list, you see the private debt program, which is the largest by both commitments and contributed value there. That program was started in 2010. Next is real estate, started in 2007. And then the bottom 2 are real assets and venture capital, which are 2 newer programs which are building out over time. I'll draw your attention to the right side of the table there, which shows the IRR, internal rate of return column for each program, as well as a PME IRR, so that's a public market equivalent. That benchmark takes the cash flow profile from each of these composites and applies it to the appropriate public market index, and so that's essentially a return of what you would have returned if those investments were made in the public space. Comparing the IRRs of each private program to the PME IRR, you can see almost all the programs are outpacing the public markets, with the exception of venture capital at the bottom. That's a fairly new program, and so that's the only one that is sort of trailing the public markets over this time period. In aggregate, the IRR for the total private plan is 8.7%, a good result. I'll go ahead and touch on the private markets program. As I mentioned, this is the biggest allocation. The chart there shows the remaining value of the plan, as well as commitments by vintage year. All the way on the right side of that chart, you can see at the end of the first quarter of 2024, private debt was about 4.5% of the total plan, and that's over the 3% policy target. The IRR for this program individually is 6.3% in total. The next page shows new commitments. At the top, you can see the Charles Bank 3 Fund was a new commitment made in the first quarter of about $5 million. I'll jump down to pages 5 and 6, and this shows each individual partnership over the years and their performance results. You can see the IRR column again here, as well as a peer IRR column, which just compares the performance of each partnership to a peer group of the same vintage. If you go up and down the board here, many of these have some really compelling returns, especially when you compare it to peer IRRs. If you look at vintage years 2018 through 2021, there's some really strong returns from a lot of these partnerships over that time period. So we're happy with performance results for this private debt program. Page 7 shows the diversification by vintage year and geographic focus. The chart on the top left shows the breakdown of funds within each vintage year, 2010 having the most allocation here, but if you look at the other vintage years, this program is fairly well diversified and pretty well divided amongst vintage years. And so that's something we think is very important, and the private debt program looks very strong when you look at it from that perspective. The next program I'll touch on is real assets. This program had a 2.4% allocation at the end of the first quarter relative to its 3% policy target, and has returned 9.5% since inception on an IRR basis. There was no new commitments made in the first quarter for this program. Here you can see the individual returns of each partnership. Again, this is one of the newer programs. The first investment there was made in 2016. If you look at this page and the next page, about half the funds have an NM for their IRR. That indicates it's a newer fund that we don't believe returns are meaningful over the period yet. And so there are some returns here, but at least half the program is still in its infancy. That's evident here by the vintage year diversification. You can see much of the exposure now is to that 2016 vintage. It's spread out throughout the other years, but not nearly as much as the private debt program, which is more mature. As this program matures, you should see the vintage year diversification become more well diversified. From a geographic focus, this is more diversified than some of the other programs. You can see there's a large allocation to the global developed as well as North America in the bottom left graph. The next program I'll touch on briefly is real estate. This has a 3.8% allocation at the end of the first quarter relative to the 3% target and has an IRR of 6.3% since inception. There were no new commitments made in the first quarter. Again, you can see the individual partnership returns here. There's some good returns out of a handful of different funds throughout the time periods and vintages years listed here. I'll note on page 18, there's 2 commitments made in 2023 and none in 2024. The investment team remains disciplined at this time, given a lot of the challenges we're facing in the commercial real estate sector, as you all know. From the vintage year and geographic perspective, this program is well diversified. You can see from the chart there, there's a handful of there's an allocation over a handful of these vintage years that looks fairly strong. The final program I'll touch on is the newest one. This is the venture capital program, which was started in 2021. Their current allocation is 0.7% relative to its 4% target. Again, this was only started in 2021, and so it has built up over time and will continue to build up as new commitments are made and capital is called. There were no new commitments in the first quarter. Here you can see the vintage year and fund performance. As I mentioned, a lot of these funds are still in their infancy, and so the results are not meaningful or very, very early in their lifespan. But we're happy with the start of this program, and it will continue to build out over time. That concludes my prepared remarks in the private markets report. We've included a handful of slides at the end of the presentation here that go into the current market. We're happy to take any questions on that or something you can reference on your own, but I'll go ahead and pause.
I have 2 questions, actually. One is you mentioned that you're making very careful investments in real estate, and I'm wondering sort of what kind of real estate you're looking into as you make those investments.
That would be a question for the staff, right?
Yep, sure, go ahead.
I can jump in. So for
Yeah.
real estate, one of the challenges has been the transaction market being slow.
Yeah.
And the one area of focus for us right now is actually the data center sector. And part of the reason that we've been very slow in our commitments is because in our growth real estate portfolio, we're looking for value creation opportunities to drive excess performance.
Yeah.
And given the repricing that's been happening because of the interest rate move, that's been unclear where capital should be placed for real estate investments. The one area that I mentioned was data centers that shows promise, and we will be making a commitment in that sector. But outside of that, we've been very patient because first, transaction markets need to pick up. And now that there's some interest rate stabilization, both the short-term interest rates as well as long-term interest rates with the 10-year treasury coming down, real estate values being repriced to close to where fair values are, where transactions are happening. So that bid-ask spread is starting to narrow down and more transactions are going to start to take place. And one more signal that we're waiting for is the fundraising market, because for private funds, funds typically took about a year to complete their fundraising. Now they're taking upwards of 2 years. So we don't want to be taking the risk of going in too early and having something happen either on the investments or at that investment firm that we partner with. So we've taken the patient approach. We have the belief that we can backfill previous investments if 2023, 2024 end up being attractive investment entry points for certain sectors or geographies. But at this point, the only thing is going to be data centers for now.
Yeah, interesting. Thank you. My second question actually had to do with interest rates, since it looks like we're starting with the, 0.5 point down from the the Fed rate might be the beginning of some further interest rate declines. I think people are anticipating that. Do you think that that's going to have an impact on these kind of markets?
I'll go first before Makita does, but I think for real estate values, the long-term interest rates are more important, so the 10-year treasury, and those have come down to around 3.7% from being as high as 5%. So that's a more positive signal for real estate values to be near the bottom and have a spread for getting a yield on buying real estate versus buying treasuries. So that's a positive signal. And short-term treasuries, somewhat for the financing perspective, but those have been more driven by the 5-year treasury for a lot of the short-term transitional real estate type of opportunities that we make. Some of those had already priced in some price cuts. Maybe this takes it even lower somewhat to make financing more attractive. And I'll let Makita.
Yeah, on the public side, you know, where we see more volatility in short-term moves for real estate investment trusts or REITs, they've responded very positively recently. We were just marveling before the meeting, up 16% quarter to date since June 30th for REITs. So eventually some of that strength will likely show up in private markets as well. I was listening to a real estate expert presenting to one of the other funds that I work with, and his theory was that real estate is going to recover, that we've hit the bottom, but the recovery shape might be more like a bathtub where we kind of bounce along the bottom before increasing a bit, than sort of a sharp reversal on the upside.
Thank you.
Great. Any other questions from trustees? All right, thank you so much. Move forward to item 4D.
Great, thank you. So moving into the pension report, I'll stop in the economic and market update here on page 5 just to provide the backdrop for these numbers that are through the end of June and also what we've seen since then. So in terms of the bars on the right side of this page here, you can see that we had quite positive returns in the second quarter through June 30th. If we look at the third quarter to date, as we sit here, about 11 days from the end of the quarter, it has also been very positive. What I find interesting is that the index returns that were the worst on this chart, these blue bars at the bottom, were actually the strongest in the third quarter to date. Just sort of indicates to me the impossibility of timing markets and why diversification is important. As I said, the NAREIT, FTSE NAREIT equity, the real estate investment trust, that index is fourth from the bottom, is up almost 16% for the third quarter to date.
Wow.
Emerging markets bonds are the JPM Global Bond Index, Emerging Markets Global Diversified, that's second from the bottom, up 8% in the third quarter to date. And Russell 2000, which is small cap U.S. equity, which responds typically more favorably to a drop in interest rates, is up 8% for the quarter to date period. So for the full U.S. equity market, looking at the S&P 500 or the Russell 3000, we're looking at another about 3% or more of returns for the third quarter to date period. We have a lot of slides in here on other economic factors that we pay attention to. We did have the first Fed rate cut yesterday since COVID times, and it was a half point rather than the quarter point that some folks had predicted. Markets did end yesterday a little bit down. We're in this strange environment where sometimes good news is bad news and bad news is good news. I think you all were paying attention probably in early August where we had volatility in the markets jump up to the highest level that we'd seen in a number of years, but then fall back down relatively close to normal levels very, very quickly as a result of a weak jobs report. Of course, the fear was that the Fed was behind the curve, but then when we had a lower inflation report recently, folks were excited about that. Of course, you know, lower inflation is good, but it also meant that the Fed was likely to move towards cutting. Unemployment has ticked up a little bit. You know, I always learned in my economics classes that 4% unemployment was basically full employment. We've ticked up to 4.3. So very, very close to that full employment number. But as you all probably are aware, we've seen a little bit of weakness on the unemployment side in the technology sector. Other sectors like healthcare have continued to add jobs. So we have a lot of other market slides in here, but in the interest of time, I will move ahead to your fund specifically. So as you know, we have a watch list. Per your investment policy statement, any fund or strategy that has underperformed its benchmark for either 3 years or 5 years is added to this watch list. We then have commentary on the next couple of slides, most of these funds that have underperformed for 3 or 5 years are either outperforming over a longer time period or rank highly in their peer groups. So we don't have any immediate concerns. We continue to work with your internal investment team on closely monitoring all of these funds. Taking a look at your overall portfolio here on page 30, the total balance as of the end of June was $3.2 billion. The balance was up about $60 million in investment gains. There were some net withdrawals for benefit payments, but did have an earnings in that 3-month period of about $60 million on the investment side. Sort of the main page in this presentation and this report that I draw your attention to is page 31. Your Chief Investment Officer already mentioned some of the very strong peer relative returns, but here you can see a lot of positive numbers and a lot of outperformance relative to benchmarks and the peer group. So for the second quarter of 2024, a return of 1.9%. For the first 6 months of 2024, a return of 5.4%. Almost 10% up for the 1-year period, so that's your full fiscal year. So that 9.7% is well in excess of your actuarial target rate of return. And you can see here that every time period out to 5 years is either at or above median of the peer group. So the peer group is the all public defined benefit plans greater than $1 billion peer group here, with the 5-year return in particular looking quite strong in the top 10% of peers. And then if you look on the next, the slide and the next few slides, you can see where all that strong performance is coming from in terms of asset class returns. Global equity in particular for the fiscal year was up 19.9%. So just shy of a 20% return in 1 year for global equity. And you can see that that return outperformed the global equity index. So if you had been invested just in a passive index, that return would still have been quite strong at 18.4%, but your active managers added value as well. In particular, one asset class that was much stronger than its benchmark and than peers was emerging markets equity. You can see the 1-year return for your emerging markets equity managers was 18.6%. The benchmark stood at 13.6%. So again, still a strong return for the benchmark, but your implementation of emerging markets equity outperformed by 5% during the fiscal year. Private markets lagged public markets this past year, but if you take a look at the longer term returns, and we look, say, at private equity has returned an average of 17.2% per year for the last 5 years. So you are well diversified, and in some market environments, public is going to outperform, and in others, private is. And this was an environment where public has been stronger. I will skip ahead just, one asset class that I highlighted was emerging markets equity. And you can see on pages 38 and 39, the individual underlying managers that your portfolio has investing in emerging markets equity on your behalf. GQG here, you can see had a 1-year return of 31.3%, was in the top percentile of the peer group. That's a manager that you all funded once Rajiv Jain, the gentleman who founded that firm. You were one of the earlier investors and therefore have a really preferential fee on that investment. I will say that GQG doesn't have true pure emerging markets exposure. They invest in NVIDIA and some other developed market stocks outside of emerging markets. But we continue to monitor that sort of style drift, but it has worked obviously quite well from a performance perspective. And then I'll mention the India managers here. So I think your fund is really on sort of the cutting edge of having this single country India exposure. India has really outperformed China and some other large emerging markets recently. And you can see here that in particular, if you look at Unify India and their since inception return on the right, they have returned on average 31.6% per year since you hired them a little over a year ago, and they rank quite highly in the peer group. I want to also hit on risk-adjusted returns, not just performance, and we have those starting on page 57. In particular, I'll look at the 5-year period, which we consider more of a full market cycle, on page 59. So you can see here that the performance was in the top 10% of the peer group. The standard deviation was below the peer group at 9.3 relative to a median of 10.1 in the second bar chart. And then that all shakes out to a Sharpe ratio, which is in the third section here. The Sharpe ratio is a measure of risk-adjusted return. So we want a higher Sharpe ratio, and that's also been in the top quartile of the peer group. So we have a lot of other slides in here that I'm happy to take questions on, or you can peruse at your leisure, but happy to take questions on the pension fund.
Great, thank you. Are there questions from trustees? Any public comment or questions? Very good,
I actually have one question.
please.
So we know that we sort of saw the public markets sort of outperforming our private market stuff. What causes the shifts? Because some years that it happens, so sort of what kinds of things might cause private markets to outperform public?
Generally, if we have a downturn in public markets, you'll see private outperforming. Private is just less volatile. It's traded less frequently. It's valued less frequently, and you don't have the huge shifts. So it typically can protect value in down years. You know, you also have a hedge fund portfolio as well, and that portfolio is invested in a lot of risk mitigating strategies that are intended to provide you liquidity in down market environments. So that's been really helpful. When we have a down market environment, you can take liquidity from those few managers that are doing well on the hedge fund side and reinvest it to your targets in equity so that you can then, you know, sort of buy low and sell high. So the diversification between the private markets, the hedge funds, and the public, we think works really well.
Yeah, thank you.
Did you want to say something?
Yeah, well, you go first.
No, I was going to say the things that drive public equity returns also drive private markets. So in general, they should move in tandem with one another. It's the same underlying economic underpinnings for both types of risk assets. Laura's right. With private markets, you know, it takes time to adjust their value. They're not mark to market daily. And in the long run, you should expect your private markets to do better than public markets because there's information asymmetry, and also private market managers have the luxury of sort of managing to a longer time frame than on a quarterly basis, which unfortunately public markets are subject to.
I have a totally different topic. I just want to thank Makita, circling back to your opening remarks about how well the plan is done for the past 7 years, and Makita's been a great partner through that journey.
Yeah, totally. Thank you.
Yeah.
Thank you. It's, you know, one thing I was going to highlight based on the comments earlier was just, you know, that all of us can't control what the markets are going to do. What we can control is the process and the governance. And I think that the performance is really an outgrowth of how well that has worked and how talented your team is and how they've been given the ability to work with us to select underlying investments.
Any other questions from trustees? I have a quick question, it's probably more for Prabhu on page 30. And I'm looking at the delta between our current allocation and our policy allocation. Given that we did make a slight asset allocation change back in April on investment grade bonds and long-term government bonds. So it seems we are, and I would have thought those are very liquid markets where it would be easy to match our current allocation to policy. So can you explain a bit more about what the delta is between current and policy there?
That's a question for Jake Kwan.
Okay.
It's nice to
Call
have
Mr.
a very
Kwan.
talented senior investment officer on the team.
Okay, and he's standing at the
He
standing microphone.
He anticipated. He
I
started
guess he's
walking
totally-
around
Yeah.
the microphone.
Totally ready for
I think when I start speaking, he moves forward. Mr. Kwan.
Thank you. So the two columns to focus on are the far left and the center column. You know, we're comparing the policy benchmark to the exposures of the plan after the overlay has been implemented. Those lines are actually very close together. I'll call them relatively close. The large deviations that, I guess the largest deviations that are there are caused primarily by the immunized net cash flow allocation. So that's less than the penciled in 5% target because we use 5% at the beginning of the year when we're modeling the strategic asset allocation. That's the de facto policy target. But the actual weight is, you know, calculated by the actuary's projected cash flows, right? And so that starts at a certain amount and amortizes throughout the year as that net cash flow leaves the plan. So that 1% and change needs to be made up somewhere. And we usually make that up by the nearest economic equivalent, and that's the within the IG bonds allocation. That's in a different grouping,
Mhm.
and that's why the color blocks look a little bit different.
Yeah.
Okay, all right, thank you.
Thank you.
Any other questions then from trustees? Any further public questions or comment? Seeing none, we will move forward to item 4E.
All
Thank you.
right, thank you. We have here the Healthcare Trust, which has a lot of the same slides as the pension. So I'll skip to the watch list again here, that we have 3 managers on watch. These probably look familiar to you from the pension report. But again, we have some commentary here, and you can see that 2 of these 3 have actually outperformed over the longer-term time period. And then you can see the total market value here of $413.9 million for the Federated Healthcare Trust, and you can see the current allocations are quite close to policy. I know we've talked about this before, but this healthcare trust is a bit more aggressive in its asset allocation than many of the peer group. A lot of the peers are really heavily weighted into fixed income in their health and welfare funds. Your fund has a target actuarial rate of return that used to be the same as the pension. Now it's just slightly lower. So in order to try to reach that expected return over time, there's a higher equity weighting than a lot of these peers. What that means is in an up market for equities like we've had recently, your fund looks phenomenal. So you can see that with the exception of the 10-year, every trailing time period peer rank is in the top quartile of the peer group. So you see a 1-year return of 9.4%, so just trailing the pension by about 30 basis points. And again, here you can see how the individual asset classes have done. This portfolio is invested very similarly to the pension, just in a smaller subset of managers that tend to be more liquid and in a bit more of index exposure. In terms of cash flows, the net investment gain for the quarter was almost $6 million. And then if we look at risk-adjusted returns, I'll highlight again here the 5-year period. You can see a much higher standard deviation than peers, given that higher equity allocation, also a much higher return than peers. And how that shakes out in a risk-adjusted return is that you are getting more return per unit of risk than most of your peers, with that Sharpe ratio ranking in the top decile. And we do have a couple slides here. We have the peer rankings. You can see this is a very large peer group. There are 240 underlying funds that this fund is compared to and looks better than. And then if you take a look at the overall allocation, again, you can see here that the average peer has a lot more in fixed income and a lot less in equity. But obviously that has worked out quite well for this fund as the market has increased.
Okay, any questions from trustees? Any public comment or questions? Seeing none. Thank you so much.
Thank you very much.
Thank you.
Thank you.
All right, moving forward, there seems to be no old business, new business. 6A, oral update from our new CEO, Mr. John Flynn.
Good morning, everybody. First, just want to give a special thank you to the boards for the warm welcome, as well as the staff and everyone that I've interacted with the city thus far has accepted me with open arms. So it's made maybe a high anxiety for me transition that much more easier. So just a thank you there, and maybe a special thank you to Roberto. I'm not sure if he's listening out in the ether, but also Barbara and Cynthia for all of the help that and guidance that they've given me since I've been here. Okay. We have recruitments underway for benefit analyst and a senior office specialist that we hope to have hires made in mid to late October. The staff is currently planning for open enrollment, and that's obviously scheduled for November 1st through the 30th. We expect the enrollment packets will go out in October. A couple of dates related to that. October 10th, we're going to be doing a presentation with the San Jose Retiree Association, and November 6th, the Retiree Health Fair at Lanninger Center from 10 to 2 p.m. ORS office lease is up for renewal in March of 25. ORS is conducting research on current markets to identify comparable locations, as well as to assess our current space needs, as well as potential additional space for growth. We're working with the current building manager to look at the needs, the availability within our current space, but also looking outside of our current space at other lease options and other office locations. We have completed a few of those walkthroughs already, and we hope to schedule some additional locations in the coming weeks. With the approval of the MOU, ORS staff will be coordinating with the chair and the vice chair and Councilmember Davis to set up a quarterly meeting to be determined, but we'll start the process of scheduling that in the coming days. We've shared the proposed procurement policy that was approved at your last meeting with the interim finance director, Drew Corbett. He and I are going to set up an initial discussion to develop an appropriate plan of action for the review of those policies so that we can bring back any feedback to our boards. As a reminder, ORS will be closed Monday, October 14th in observance of Indigenous Peoples Day holiday. I'd just like to give you a quick transition update. I've had many one-on-one sessions with Roberto before he left, as well as with Barbara. I had a good session with Jennifer Shembri and some of her senior staff for an OER and labor relations overview, and we've scheduled another meeting to do a deeper dive into ORS and OER relations. Met with many board members with the last few scheduled in the coming weeks. Again, thank you for Cynthia for doing all the coordination that requires with meeting with so many stakeholders across the boards and the city. I had a very good meeting with the city manager, Jennifer McGuire, yesterday. She welcomed me to San Jose, gave me some good in-depth overview of the city, and reinforced her one team mission, and very clearly let me know that she and the rest of the city directors were here to help me in my transition, and if I have any questions, that her doors are always open. I met with many council members, including Councilmember Davis, for our first session. We kept it pretty high level, but we're going to schedule we have a monthly cadence set up, and I think that'll be very good for our relations. I've met with many of our critical service providers, Bill and Ann from Chiron and Craig from MGO. I'm scheduled to meet with John and Dan from LRS, our pension gold providers. I have some meetings scheduled with Mayor Mahan and Nora Freeman from the city, Councilmember Foley, and looking forward to my remaining council member sessions that are, I believe, we're all scheduled at this point. And soon I'll be reaching out to Jim Shanahan, the director of the budget director, to start to get his view of the process and give me an overview of how that works with the city and where our integration points will be. Any questions from any of the trustees?
Can I make one annoying operational comment
Of course.
that you don't ever need from a trustee probably? Having done commercial real estate or getting new leases for companies that I've been involved with, you are right now in September, and March is going to come up fast. I've been burned by not being ahead of the curve enough on that. Just a little forewarning.
Okay.
Thank you.
Any other trustee comments? Any public comments or questions? Just want to say welcome again to Mr. Flynn as our new CEO, and know you're drinking out of the fire hose at this juncture of your tenure. but we wish you Godspeed, and you have our full support.
Thank
So-
you.
All right, we're ready to move forward to item 6B, which is an oral update from our council liaison. Ms. Davis.
Good morning. I want to add my welcome to John, and you seem to be drinking from the fire hose successfully so far. So appreciate you reaching out to all the council members and also to your counterparts at the city. With that, we do have an interim director of finance right now, and we will be adopting our statement of policy and city council questions for the prospective new director of finance on October 1st. So because finance is such an important partner to this department, to ORS, if there are any questions that you want to make sure get covered, please let me know, and I will bring them up at that meeting. So that's in 2 weeks, about 2 weeks from now. We are also, with Jennifer Shembry was promoted to deputy city manager, and so we also have an open position for director of OER and HR as well. And we just adopted those policy questions, I believe, at our meeting this week. I think we did that this week. So yeah, we have a couple of open positions, and they impact the relationships with ORS, so just wanted to make sure everybody was aware of that.
Hey, Councilmember Davis, I have a question. As to the interim finance manager, is this someone internal to the city, or can you tell us a little more about him? And is this, as you say, interim, but then I heard you say something October, announcing a new director?
No, sorry, we're not announcing a new director. We're adopting a statement of policy and questions for the search. So basically, that's the commencement of the search for a new director.
Okay.
And the director of the interim director of finance is, I believe, a former city employee, but it's not an internal. It wasn't an internal appointment.
So it's from a consulting agency or something?
I think it was a retiree, but I'm not positive.
Really?
Yeah, I don't
recognize the name, but.
I don't remember, Julie, the details.
Do we have an assistant director? Oh, we do, right? Do we have an assistant director of finance?
That's not a level of detail I know.
Okay.
Any other questions from trustees? Any public comment or questions? All right, thank you so much. Item 6C, we have already covered, so we're on to 6D, which in fact is our trustee self-assessment of the board performance. So. Walter is unavailable, unfortunately, today, so we're going to have to handle this on our own. So hopefully we can do our best to self-assess our self-assessment. So. And that is item 6D. Here we go. So we all participated. I believe every single trustee submitted answers here. I think Walter, in his memo, did highlight the key findings and areas of interest. Generally, and maybe not surprisingly, we gave ourselves pretty high marks, and we graded on a curve. But I think possibly. I think one area that comes up in my mind is, I think, and I feel this personally also, is as trustees, our limited ability to monitor things like member services and internal operations within the Office of Retirement Services. And I guess I just open it up to discussion about any other observations that trustees have had about our effectiveness, or any ideas on how we might improve our performance going forward. It's a difficult area. As board members, we don't necessarily have a lot of insight into the day-to-day workings of the office. We're not there physically. We have limited interactions with members of the staff. Those we do have interactions with are the ones we frequently have interactions with. So it is an area of challenge for us.
Mr. Chair, I can say that the Disability Committee makes a lot of use of staff.
Mhm.
We've gotten terrific support there in preparation, the preparation part,
Mhm.
follow-up part, and you'll see one of the items we have today of a policy adjustment.
Mhm.
So it's appreciated all the way through. You know, Sandra and Amy and Jessica and Russ, and so on. It's, so on that side, I do think that the comment that 7 board members stretched out over the committees is
Mhm.
tougher than 9 board members stretched out over committees.
Yeah.
So I thought that was good, and I felt that overall it was a pretty positive feedback from ourselves, to
Mhm.
ourselves.
Okay. Well, sometimes the self can be the harshest critic.
That's right.
And I do appreciate the great work that the Disability Committee does, and obviously we would be nowhere without staff support.
Yeah, we would be nowhere without staff support. It takes a lot of staff work to even
Mhm.
get one case in front of us.
And they're very complex cases. And indeed, staff support for all the functions that we either do or oversee. We are challenged, more so than police and fire, in the fact that we only have 7 members, and we need to spread them over just as many committees as they do. So I would say I appreciate all the work that the trustees do in staffing out these committees. And every one of them has been busy. In the past, some committees have been a little bit lighter, but it seems this past year we've all been pretty active. There's been a lot going on.
I
It's-
have one comment, and
Please.
that had to do with sort of the in-house education.
Yes.
And I'm not sure that we have in-house education on a formal basis, if it happens at all. It's sort of ad hoc as issues arise. But I'm wondering if that's something that the board thinks that we should be doing.
That's good.
Yeah, it seems, do you have a comment? Or
We used to do trustee offsites when I first, I don't know when that stopped, but there were almost twice a
Probably
year.
with COVID.
Twice a year.
Was it COVID? I thought it might have been.
I don't know, I wasn't on
yeah.
until 21,
Might
but
have
that'd be
even
my
been-
guess. It probably stopped with.
And are you
think-
talking about actual offsites where we weren't here? Because when I joined, we had a quote offsite, but it took place in this room in September.
I had both.
Mhm.
Location less important, but like getting together outside of these board meetings to
Mhm.
discuss educational stuff.
Maytag, it seems like it was.
The last time we had a strategic planning retreat, I think that's what you're referencing, was 2019.
Yeah,
it was wow.
pre-COVID.
Okay, and I think either pre my tenure and pre everyone else's tenure. It seems like this is something we don't do. We have a lot of support for educational resources. We all go to different training sessions, which are great, and conferences. I don't know if there's necessarily a strong desire for us to have in-house together training sessions, but I think having some type of offsite where we talk more strategically and broadly about the direction of the plan, I think would be worthwhile.
Yeah.
So if that's what's meant by group training, it's probably something we should pursue. It may be difficult to fit that into our agendas because we always seem to have full agendas with all of the, let's say, more mundane day-to-day tactical issues that need to be dealt with. So,
I've seen in some other funds where on a regular cadence, they'll bring in some educational topics to the board meetings themselves. Now, they will add to duration of each board meeting, but whether it's an investment-related educational topic or actuarial related education outside of some new trustee onboarding related educations, but that's not what we're talking about here. But that's separate and apart typically from an offsite or a retreat, however you want to. That's usually a half a day of education, and then a half a day devoted to strategic planning, strategic discussions, putting together, either creating or reviewing a strategic plan, or reviewing a plan of action based on a strategic plan for the upcoming year or however long. So.
And I would reflect on that, obviously, as a part of our regular meetings, when our actuaries come, it is always an education, I think, for members. And from time to time, our CIO has brought in various speakers on investment issues that have addressed us, so that is a form of group education.
Chair, the last time the board had a retreat was in 2020, September 2020.
Okay. Let me leave it then as an open item. If there are issues of strategic interest and importance that we think we should address, if you want to communicate those to the chair, and let's figure out a way to, to prioritize those, and then figure out a way to have a retreat and discuss them.
Yeah, Maytag, I know Harvey in the past would take some time to educate trustees on various issues. I think fiduciary duties was one.
Yeah, usually we do a fiduciary training per year for the board, and also a refresher on the Brown Act. As you recall, this year's been pretty busy. We can certainly add that in the coming months.
Yeah. Sounds good.
So can I ask a question about another topic of the review?
Sure.
Outing myself, I was in the minority of people who thought we have too many meetings. And it's interesting that at this conference that, or event, I don't know what to call it, that Prabhu and I attended the past couple of days, and this is not my first time experiencing this, everyone is shocked at the number of board meetings that we have. We are so outside the norm. And so I just wanted to raise that. Clearly, 5 people think it's fine.
I believe I was the other vote for too many.
I mean, I think board meetings generally in other jurisdictions go for much longer per board meeting, but they meet less frequently. So they cover the same materials, but it'll be nearly a full day or a day and a half. We tend to be pretty good and get out by lunchtime, but sometimes they go a little longer. But they consistently go for a day and a half to a full day, but they meet far less frequently.
What is the average frequency?
4 quarterly.
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 I think benchmarking our operations and performance versus other boards might be something that's worthwhile doing. And I'd be curious to know, since you said there were endowments there as well as public plans.
I was only speaking to the public plans. I mean,
okay.
I have to, people's eyes get wide. They're like, holy crap. They feel bad for staff. See, they have to go to that many meetings.
Yeah, it's a lot, I think. Of course, I'm up here talking the whole time, so it's really a bit of a challenge in that regard. We're driven by our agendas, which seem to have a lot of stuff that needs to be covered. I'm not sure if we can explore ways to minimize the agendas, streamline the agendas. I think we work our way through it pretty reasonably quickly, but I'm not sure what we could drop.
I have a comment on that. One of the things that I really found last year is that we had issues that came up, and it took us a long time because we only met every month, because we talked with the audit committee or some other committee, and then we'd bring it to the board. And if we only met once a quarter, we would not be we would not have an opportunity to address those kind of issues at all.
That's a very accurate assessment of many issues that came up, particularly ones that were emergency or surprising or unexpected. So
I don't know how other jurisdictions deal with, I mean, this last year was unique, but it could happen again.
A quarterly cadence would simply not allow us to timely respond to many issues.
This may be a question for John as well, what he thinks about the agenda items that are, if they're coming less frequently to the board, maybe we can start once in 2 months to, just to try it out.
Well, so I challenged you to send forward any ideas for strategic consideration by the trustees. If you want to forward any normal or typical or recurring agenda items that you think we could drop safely, have at a lower cadence, please forward those to me. Be respectful of the Brown Act, so let's have it as a one-way communication, and maybe I'll take it on to sort of delineate and prioritize those as I get them. So I don't know if, is there a legal requirement that we meet monthly? I think there may be, no?
No, but there's no requirement, for example, that you meet monthly, but I do want to just highlight one thing. For all the other SERL systems, they do meet monthly. One thing to consider is also that the board needs to approve all the retirement applications, and so if we were to meet quarterly, we would hold in abeyance a number of applications that would need to be approved. So that might slow the administrative side of things down just a tad. So that's one thing to consider.
Okay.
What were you gonna say? What I was gonna say is you're already working with a consent-based agenda, which takes some of the regular agendized items and moves them very quickly.
Yeah.
Some boards don't do that, and so that would have been something, an area to focus on. But, you know, at the end of the day, it actually is a fairly lean agenda. Not meaning that there isn't a lot to talk about, but that I think it's organized well and pushed through very quickly. But I do think that there is real value for us to consider. Again, I'm still trying to wrap my arms around everything, but an annual strategic planning session where we can integrate some of the group learning components, but that is something that is very high interest for me, to put together a longer term strategic plan, both for Federated and for police and fire, in me trying to keep everybody aligned in where and how we're moving forward.
I wonder about something else compared to the peers you met at this conference. We have a fairly young board in terms of our tenure. I wonder if they are more experienced, that they can, quote, blow through agenda items more quickly as compared to us. I mean, some of us have only seen the actuarial presentation once or twice, so it's a lot to renew every year.
Well, I mean, we would still have that. I mean, we'd have fewer meetings that'd be longer, so this cutting of the agenda wasn't at all what and I'm not advocating, I'm responding. We meet more often so it's something that I don't think we should resolve today.
Right, no.
But this has nothing to do with cutting the agenda. It would be longer meetings, meeting less frequently. Council Chin has brought up some points where less frequent has an impact. Let's not have that tactically now. If other people are interested, let's have a real separate conversation about it. If it's only the two of us, then it's moot. If everyone else enjoys each other's company 11 times a year, that's fantastic. I'll keep coming. I've been doing it for 8 years.
Wasn't hoping to resolve it today, but I welcome the fulsome discussion and the observations. Particularly, we don't always get outside of ourselves to compare ourselves to other plans, other systems, and understand how they operate.
They tend to be far more hands-off, is what I can tell, including on with the investment team and committee and their reviews, and that's my general sense. And it's not just from this last. That's the last note I'll make. It is a consistent feedback over several years of attending conferences.
Understood. All right. Any other trustee observations?
No, we have an opportunity with our new CEO to look at all these things.
Yeah.
Absolutely.
Yeah, I think one that fits in the strategic planning idea sounds great, to have some sort of retreat if we can fit it within whatever we can communicate about it, a retreat. But I find the discussions on, as Prabhu just mentioned, where we came from and the changes that were implemented and why, as a new board member, understood, but not as in depth as someone who worked on it. So having the senior board members or staff that work through it kind of give that institutional knowledge, so that the new or myself at least specifically as a new trustee can understand that, so that if I'm here a while, I keep pushing those agendas that were fixed for a reason and not lose sight of what happened and why.
Yeah, and if I might just chime in. So, for example, OSERS, I'm fiduciary counsel for OSERS, and for their September meetings, they would treat that meeting date as their strategic planning, and then have that entire day be that meeting. So they do it regularly each year in September, where they designate one of the already scheduled meetings to be the strategic planning.
Yeah.
We did that early on in my tenure.
Yes, that's right. Obviously, you were here in September, and we're not doing it now. So.
I don't recall any strategic planning meeting per se, right, for us.
In my first couple of years here, we substituted a board meeting for a strategic planning with for a board meeting with strategic planning.
Okay. All right, if there are no other comments, public comments, we will proceed to the next agenda item, which is
6E.
6E, thank you. Approval of non-pre-approved travel for trustee Abbott. I think we all had the packet on that. Is there any particular, this is part of our new travel policy where any travel that is not to one of the typical conferences like Calipers or Sackers or so, there's a few others on the short list, has to be individually approved.
So I'm about to make a motion to approve. I just was curious, that can't go on the consent calendar? That item?
Well, it's a good question, since we just talked about agendas.
I think because it's not regular, is that why it's not on the consent?
Well, so the rules for consent, so for example, under the Brown Act, it doesn't specify specifically what can and cannot be on consent, other than, for example, executive compensation or other compensation issues. Generally, the Brown Act has been interpreted for the consent calendars to put routine, non-controversial items there. Given our, the atmosphere around our travel policy, we made the strategic decision not to put on consent.
I see. Thank you for that clarification.
All right, but that's something we
probably
could
should've-
revisit in the future and begin to.
We certainly can,
Okay.
if the board feels that
Highlight
it's
it now.
non-controversial.
Okay.
Well, I'm sorry.
So
I
it sounds like
was
you're
just
about to.
saying, I've had a chance, I'd like to make a motion to approve it.
Okay, is there a
Second.
second? We have a motion from trustee Chauncey, a second from trustee Linder. Any further discussion? Seeing none, we have to have a roll call vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
I think I have to abstain.
Okay, trustee Vasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
Chair votes aye, so it is approved. And let's take it as a future agenda item to discuss and potentially approve placing these on the consent calendar in the future. On to committee reports. The investment committee did meet in August. We have an oral update from the chair of investments.
I think we actually got a more comprehensive investment overview today for the entire board. At the board meeting, we covered all the non-public equities, public assets, essentially, with Senior Officer Jay Kwan. So informative, but we certainly got a more comprehensive overview of how the plan is performed and the underlying assets today.
Okay. Any questions from trustees? Okay, and from the public? Seeing none, we'll receive and file the minutes. On to the audit committee. Chair Vasti.
The last joint audit committee meeting was on August 15th, and the next meeting is October 17th. We have a couple of items here. Minutes for receiving and filing. In our last meeting, we got an update on the status of request to the custodian bank to correct the fiscal years 2016 to 2023 pension plan returns based on the results of the work that was performed by MGO. The work is completed, and we are expecting the next ACFR to include the corrected returns. Then we have a discussion and action item on the proposed timeline and plan for implementing the recommendations of the city auditor's report. This report includes the responsible individuals' commitments and the target dates on the action plan to address the findings of the city auditor. And then the last item here is a discussion and action to approve amendment to the Federated Audit Committee Charter to reflect the changes regarding the hiring and performance evaluation of the internal internal auditor. So we made some changes in the internal audit charter, and just to ensure that the audit committee charter is aligned with the internal auditor charter, we are making these amendments.
Okay. Go ahead.
Anything that you would like to add, John or Matek?
No, you covered it, but we do need a discussion, an action on item 7.2D and 7.2E, D and E.
Okay, so with respect, so we're gonna receive and file the minutes. With respect to 7.2D, where are we with respect to, I believe this is an item covered under the MOU with the city, our implementation of various items by September 30th, is that correct? am I mistaken about that?
So the MOU specified that the boards adopt policies for the operations of ORS by the September 30th deadline, and to the extent we have any additional policies that we are going to adopt that are new, that we run it by the city, in which we have done with regard to the contracting and procurement policies. We've provided that, I believe, John can confirm, to the finance director for their comments. With regard to the implementation of the city auditor's report, that was a separate, if I recall correctly, it was a separate representation that we made to the city when the city auditor's report came out, that we would come back with our responses by this date.
So the proposed procurement policy for goods and services was sent to the interim director of finance, not reviewed or have not received feedback. It was just this week. He and I are going to meet, or we're trying to schedule something in the next week to put together a plan of action for the review, not just not just for that policy, but for any policies. You know, he's also new, so he has the same look on his face when somebody asks him a question that is being asked for the first time. So we thought it would be good for us to put together how we're going to work together and make sure we're having the right people in our organizations speaking to each other. So, but this board did approve the proposed policy within the deadline imposed by the MOU.
So is there any further discussion on accepting the proposed timeline? Any further questions? Would someone like to formulate a motion to accept the proposed timeline?
So moved, Mr. Chair.
So we have a motion from trustee Linda. Do we have a second?
I'll second.
I heard trustee Abbott first, so we're going to give the second to trustee Abbott. Any discussion on the motion? Any public comment? We will vote, and the vote goes first to you, Vice Chair Jennings.
Aye.
Trustee Abbott.
Aye.
Trustee Avasti.
Aye.
Trustee Chandra.
Aye.
Trustee Faulkner.
Aye.
Trustee Linder.
Aye.
And the chair votes aye. Now we move to item 7.2E, discussion and action to approve the amendment to the performance and valuation for the internal auditor. And is there any questions about this proposal?
Can you say that again? What is this?
This is the discussion and action to amend the audit committee charter to reflect changes. We have red line changes to the hiring and performance evaluation of the ORS internal auditor. And those are contained in the attachment. The red lines are actually quite limited.
Right.
I don't know, Maytek, do you want to comment on any of the changes at all?
Well, I can. So the changes in the substantive change
Yes,
that we added to the Federated Audit Charter mirrors what we did to the internal auditor charter. So this is a housekeeping measure to make sure they're aligned, as Trustee Avasi mentioned.
Okay, so fairly minor changes then in terms of effect.
Yeah, so substantively, they added the process of having an ad hoc liaison from each of the boards work alongside the CEO to interview and evaluate the candidates for the position.
I see. Okay. And just to clarify, that position is currently open.
Currently open.
Right. Okay, so I'll entertain a motion to approve the recommended changes to the document.
I so move.
We have a motion from trustee Abbott. Do we have a second?
Second.
Second from trustee Linder. Excuse my New York accent. Any further discussion? Any public comment? Hearing none, we will vote. Vice Chair Jennings.
Aye.
Trustee Abbott.
Aye.
Trustee Avasti.
Aye.
Trustee Chandra.
Aye.
Trustee Faulkner.
Aye.
Trustee Linder.
Aye.
Chair votes aye. It is approved. On to item 7.3A. Governance. It looks like we had a meeting only back in June. I believe we've met since then. Mr. Linder, is there any update from the governance committee?
No, we will be meeting in December. We were going to meet this afternoon, but it works better to meet in December.
Very good. Thank you.
We have all the players here.
And again, Mr. Linder, we have the disability committee.
Yes, there are some things here. We do have the minutes. And the major action is related to the changes in the policies. I'll set the framework, and then I'll ask Sandra to kind of walk through it. This policy change started when we were looking at how to over-communicate with people who are considering filing for a disability retirement, but we don't hear from them, and then all of a sudden we hear from them. So is there a way that we can communicate more effectively? We adopted an idea to try that Trustee Faulkner recommended that we take a look at it after 6 months. We did. We found some things that needed to be corrected because we found an inordinate amount of staff time trying to track everybody down, send them emails, send them calls, everything else. I mean, the work of Jessica and others on there was exceptional. People liked it, but we still weren't, it was just too much time. So I'm going to ask Sandra to kind of work through, because she and her staff did the work. Trustee Faulkner was very active in coming up with other ideas. So Sandra, if you don't mind, I'm going to turn this to you to kind of highlight the changes we made to kind of still communicate, but not take so much staff time to do so. Especially as we know we have a lot of work to do on this stuff. So thank you. Sandra, you okay?
Thank you. Thank you, Chair Linder. I'm happy to go over this. I think, as Chair Linder was saying, I think one of the main changes we made in this proposed revision is that in our initial policies, if someone was non-responsive to our outreach, that the policy defaulted that the application would move forward in the process. And that was, as Chair Linder said, it's actually the same amount of staff time to process a non-responsive applicant. I think our threats in our emails were, if you don't respond, we're going to process your application. So I don't think it was very encouraging for people to respond to us. And then it was just very hard for us to prioritize those over applicants who were responsive. So after some discussion and discussion with Maytech, we the main change here is number 7 on the policies. I think number 7 and in number 13, where at the time of application, we're going to ask them to verify that they understand that if they're non-responsive, their application will be withdrawn and not processed. And then if we go through, and we do have a lot of outreach that we are doing with them. When we outreach to them, if they're non-responsive after 2 attempts at contacting them through all the methods we have on record, email, phone, mail, within 90 days, we send them another letter, a final notice. We give them another 30 days, contact them again, and then proceed. So they have about 120 days, and where we contact them 3 times during that period that they have to be non-responsive to in order for us to withdraw their application. And then, of course, I think we have some ability to, if they contact us with some special circumstances, perhaps they were in the hospital, something like that, we would have the ability to look at that also. So that is the biggest change in these rules. Another change under number 11 is just to clarify that non-responsive kind of also includes non-compliant, because what we are finding is people perhaps were trying to schedule a meeting and they may say, let me think about it, or I'll get back to you, and then that sort of resets the 90 days according to the rules. So we're clarifying that it's actually also cooperative in our requests also is a requirement under non-responsive to qualify to process the application. Or, if they're non-cooperative after 90 days or 120 days, it's going to be treated as if they were non-responsive. Okay. I think those were the main changes. There were some other housekeeping changes that I don't know that we need to go into detail on. If that's okay, Chair Linder.
I think that pretty much covers it. We're going to keep watching this. I mean, it's a balance of customer service and staff resources.
Right.
And cooperation and lack of cooperation and so on. So about every 6 months, we'll keep checking on how this is working.
Have we benchmarked best practices at other plans? I mean, we're not the only ones dealing with the same issue.
I haven't benchmarked. I don't know if Maytech knows of other.
No, we haven't looked at other plans for the how they go about dealing with their disability applications.
Actually, I think Russ Requeta
Russ
is
had
here
done some
via
look at it.
Zoom. I don't know, Russ.
Our
if-
disability attorney, yes.
Okay.
Yeah,
There he is.
yeah.
Okay.
Magically.
I think it would be a very significant undertaking, maybe well worth it, to determine what other plans do. In my experience, there's wide variety. They, even though we're all aiming at the same general questions, the same general goal, the approaches to get there vary widely, from systems that have no rules to systems that have enormously complicated rules. And so that, so though no benchmarking has been done, it certainly could be done, but at least in my experience, albeit limited, I'm not sure how much utility that would be for the boards, since these are the rules that are really fine-tuned to the operations of this board, this disability committee, and the experience of that disability committee even before these rules, and the experience of staff when there was not a board member disability committee. So it'd be my suggestion for board consideration that benchmarking is not necessarily a useful use of staff time.
Okay. Yeah, maybe not benchmarking, not a comprehensive review, but certainly looking at maybe one or two other plans, best practices.
And we have, I know I have been in touch with the city of Fresno at one point, about a year or so ago. So yes, I do appreciate that feedback.
All right, then, if there's any further.
I have one comment.
Please.
I just think that 3 contacts, no response sounds perfectly fine
Sounds reasonable,
to me.
yeah.
You know, I mean, if you want to proceed with an application, then you need to be responsive. It doesn't mean that they couldn't come back and reapply if something happened, or if there are extraordinary circumstances like they're in the hospital. I mean, it seems completely reasonable to me.
Yeah.
It's always remarkable who pops up at the last minute. I know I haven't talked with you for 6 months. Here I am.
It would seem the applicant would be motivated to identify themselves and step forward, so it is difficult to understand.
But I'll
but
move
it
the
happens.
approval of these,
Very good.
this new policy.
Second.
We have a motion from trustee Linder, second from trustee Faulkner. Any further discussion by trustees? Any public comment? Hearing none, we can vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And the chair votes aye as well. It is
Right.
adopted.
Thank you to the staff for really working with us on this.
And thank you to the committee for your support.
Okay. Next, we have 7.5, the JPC. It looks like we haven't met since April 25th.
Yeah, I was trying to honor trustee Chandra's idea of limiting meetings, so we haven't had any JPC meetings.
Which is something that committee failed at miserably in the last 18 months.
Yeah, it was a short hiatus from a very busy schedule prior to
After an
that.
incredibly busy schedule.
Thank God we haven't met since April 25th.
Okay, you're,
But we should note that I'm the vice chair, so that trustee Mendon on police and fire doesn't think we're trying to create a coup over here. I'm the vice chair of that committee, not the chair.
yes, certainly need to recognize that. Did I say otherwise?
No, it's, you did not. It's
No.
written as I'm the chair in the agenda.
Yeah, and it says
Okay.
oral report from the chair, and the
Okay.
chair is not here.
The
Yeah,
chair.
no, we certainly want to respect our sister plan. Item 8, education and training. I think you can all see the various programs available to us. SACRS is coming up very soon, but I haven't seen a full agenda from them, other than a bare skeleton. Any proposed agenda items? If not, we are in adjournment at 11:30.
Great.
Another good job, Mr. Chair.
Thank you.
Recording stopped.